Well, I don't know if you've heard the news. I don't know if you've heard this. You may have been living under a rock if you haven't heard this news. The stock market is crashing in 2021. That's the truth. That's the unfortunate news. This has been declared exhaustively by the biggest financial influencers across social media. The stock market is going to crash in 2021. This is the truth. It's been explained many times. And not only the stock market, but the housing market as well. That's going to crash as well. So I was actually excited. I felt like we went through something really tough in 2020. We all had a difficult time. Some of us suffered more than others because our lives were disrupted. Many people lost jobs. Obviously, many people were hurt by the coronavirus and the spread of it. It's been a tough year. And I was kind of excited for 2021 as we come out of this year. As we get a vaccine, we get more immunity, and many of us get our jobs back as the unemployment rate goes down. I was pretty excited about 2021 until I begin to see how bad it's going to be. Let me give you an example of just a few videos that have been made by some of the top financial YouTubers on YouTube. Now, these are no amateurs. These are the top of the top. These are the ones that I can learn a lot from. They make the best thumbnails. They make the best content. They get the most views out of anyone on YouTube. Combined, they get millions and millions of views. They have a tremendous amount of influence. So let's go ahead and look at some of the warnings they're giving us right now. I'll throw these up on the screen so you guys can see some of these thumbnails. The first one we can look at is from Andre Jike. He has one that says housing crash in big letters. He looks very concerned in this one. In fact, he looks like he's having a very tough time, with this news. And the title is The 2021 Housing Crash, My Thoughts. So he's going to give us his thoughts on the 2021 housing crash that hasn't happened yet. And it's not just the housing crash. We also have the stock market. Here's another one. The stock market with a huge red arrow going down. And it says, a warning for all stock investors. Again, this is Andre again, looking very, very concerned about this. I mean, just look at the photo. He's pretty concerned about this. I feel concerned just reading that. We have Graham Stephan, who is probably the king of financial YouTube right now. He's the one that has the most eyes on him. He gets the most views. In big letters, 2021, with the red stock chart going down. And he says, my thoughts on the 2021 stock market crash. So this is said almost like it's definitively going to happen. And he's just sharing his thoughts on it beforehand. We're going to have a crash in 2021. And he's just giving his opinion on it. We can move on to other ones. We have Jeremy here, the stock market crash of 2021 coming, how to prepare. So at least Jeremy's giving us advice of how to prepare for the upcoming stock market crash. Presumably he's going to tell us what to do with our money, what companies to invest in, all that good stuff. We can go on. This isn't only one video from each of them. Sometimes it's many. We have Graham Stephan. This one was from 3 months back. The upcoming stock market crash, the upcoming stock market collapse, round 2. So we had the one in March because of the coronavirus, and then there's a question mark with another one coming up. And in this one, Graham looks particularly sad about it. He looks very concerned. So you might want to check out why he's so concerned on that. And then again, I can give out more examples. I don't want to leave Ryan Scribner out. He has a big, shocked face with this one, negative 20%. Warning, my thoughts on the second stock market crash. We don't want to leave out Meet Kevin. This guy, I admire his work ethic. He works harder than any YouTuber ever. He's uploading videos like every 20 minutes onto his channel. It's pretty incredible. This one, he has crash in all red. The December stock market crash, do this now. So he's giving instructions of what you need to do right now. But this one isn't the 2021 market crash. This is December. He's saying there's going to be a crash this December, which, what is it? What's the date? It's like the 17th. This is coming up soon. We only have a couple weeks for it. And he actually came out with another video update, the New Year's stock market crash. So we're going to have one on New Year's. I think he's moving the crash back a date. He's scheduling it in for a different time. It was in December, and now it's going to be in 2021. And again, he's instructing us on what to do. And then we have another one from Meet Kevin. This was from 3 months ago. This is another big warning. He's also looking very sad about this one. What the end of the stock market bailout means, market crash, question mark? A little bit of intrigue there from Meet Kevin. Makes you want to click on that. Usually the Fed has been very helpful with the stock market. So I'm doubting that they're going to do anything that's going to crash the market. But anyway, like I said, I don't want to single anybody out. Luckily, there is a lot of examples of this. We have another one from Jeremy. I can show 25 stocks to buy in 2021, with this market crash coming up. So he's giving us specific instructions on what stocks to buy for the market crash that doesn't exist. We have minority mindset. He says the 2021 stock market crash explained. So he's going to explain that for us. He's also going to explain the housing crash, the truth about the 2021 housing market crash. That's one we're getting the truth in. We have Meet Kevin again, the Fed update, first sign of a market crash coming. I don't know. It might be. You probably have to click on the video and find out if it is. We don't want to leave out Nate O'Brien. He has 5 reasons the stock market will crash again. That was 6 months ago. So we're still waiting on that crash of negative 40%. And then we have other videos like this from Graham Stephan again. I have a lot of video examples of Graham Stephan, but come on, he's the biggest one. He's the big guy. He's the one with the most influence. So I think it's important to see what he's warning people about. He says, why I'm selling my stocks. And again, he's looking very, very sad. Now, this one I actually did have time to take a look at. And this might actually shock you because it shocked me, but it was a little bit clickbaity. He's not really selling all of his stocks. In fact, he says he's just selling a few of them for tax loss harvesting purposes. So he got me with a little bit of clickbait there, but I'll give him a pass on that because that's not something that he normally does. Now, like I said, I'm not trying to give these YouTubers a tough time. These are the best there is, right? These guys have the most viewers, the most influence. I have a lot to learn from them. So I'm not trying to give any of them a hard time. They're just making content that has a lot of demand. And discussing stock market crashes has a lot of demand. People want to discuss this stuff every day. It is dramatic. It is based off fear. It gets clicks. People have these things in them that say stock market crash. I need to click on that and find out what's going to happen. What does this person know that I don't, that I can avoid something like March, right? Something like the last crash. The issue is when we talk about stock market crashes and when they're going to happen, nobody has a clue. That's the truth. Nobody has the slightest clue of when it's going to happen. Some people will tell you that they know it's going to happen and that they know because of specific reasons. This is one thing that Peter Schiff has done for like a decade. He has no clue. Neither does Graham Stephan. Neither do I. Neither does Warren Buffett or Peter Lynch. None of these guys, whether they're the most legendary investors that have been in the markets their entire life, or they're just new people that have read about the markets, none of them have a clue of when the next crash is going to be. But yet we discuss it every day. Every single day. If we looked out 2 weeks, how many videos are going to be made about the stock market crash? Probably another 20 from just the top guys. It's something that has frequent discussion, but stock market crashes have happened very infrequently in the past. They happen on average once every 8 years. The one that we had before the one in 2020 was 2009. It's 11 years ago. That's a long time. For people that were fearful, that stayed out of the market during that time, they missed out on tremendous returns over that same time period. Just to give you an idea of how much people had no clue of the stock market crash in 2020, Ray Dalio, which is one of the great financial thinkers, he's somebody that's authored books on the stock market and investing and balancing risk, all that good stuff. He said that cash is trash 3 months before the market crash. And all anybody wanted in the market crash was cash. That's all they wanted. They just wanted to raise cash, sell out of different positions that were getting hurt, and they wanted cash. They were raising cash to make their portfolio more defensive. And 3 months before that, some of the biggest, well-known investors, most respected, were saying that cash was trash. That's the situation. That's how unknown it is to people. Nobody has a clue about it. But we discuss this type of stuff all the time. It's super frequent. I'm sure if I checked again YouTube, I'd find another like 3 videos about it. And it's not just on YouTube. It's on TikTok. It's on Twitter. If we go to Reddit, we can discuss it there as well. Let's look at this post. Wall Street is preemptively positioning retail investors as a scapegoat for the cause of the next crash. So the next crash is definitive. Looks like it's going to be happening pretty soon. This has 1,200 upvotes and it's in the stock subreddit. So this isn't some like unknown niche kind of conspiracy theorist subreddit. This is just a mainstream financial subreddit. And he's saying that Wall Street is kind of conspiring together. They're kind of making retail investors the scapegoat. He goes on to explain how they blame retail investors right now for everything. So when the market crashes, they're going to continue blaming them. That's the purpose of his post. It's probably true. Wall Street will blame anybody else but themselves. So that part is true. But you see my point here. The discussion of stock market crashes is frequent. You're going to see it every single day. Now, when we discuss stock market crashes so frequently, and there's so much content being made around it, it can make people heavily influenced to make, I think, poor decisions, poor financial decisions. One of them is being scared of the stock market, being scared out of it because of prices, because of the economy, because of the Fed, because of whatever reason. There's always a million reasons to not invest. In fact, if you want to not invest, you will find a reason why now is not a good time to invest. That's the honest truth. And there's usually a lot of them available. Most of the time, I don't think it turns out good. I think that people that stay out of the market end up losing far more money than people that stay in it, and they suffer through a couple market crashes. For instance, here's one video. This is from another YouTuber. So again, I'm not trying to pick on anybody. All of us make our decisions. We have our reasons for it. This one is from Beat the Bush. He says, I sold all my stocks, right? And unlike Graham Steffens, this one is not clickbait. He really sold all of his stocks, and he goes on to describe all the different logical reasons of why he's selling his stocks. And this was in May 11th. So keep in mind that since the time he sold his stocks back in May, the stock market, just like the S&P 500, has gone up well over 25%. So it's been quite a rally since this video of when he sold his stocks. Now, I'm not trying to criticize him, because if you actually look at his reasons for selling his stocks, they are solid reasons. These aren't bad reasons to sell right now. Let's go ahead and listen to some of it.
This is another instance where I feel like the risk versus reward is just not worth it, and that is when I decide to sell everything. Let me impress upon you guys the severity of this situation.
If we fast forward to right now, current day, obviously we can look back and judge people's decisions, but I think if we rewind back to when he put out this video, it got wide approval. People didn't say you're dumb for selling right now. Not that many people, everybody has their opinions, but it wasn't like unanimously that people were criticizing him for selling right now. Only later on can we judge the decision with 2020 hindsight, but at the time, this was a different situation. In May, things were much scarier than they were right now. The market had gone up a little bit, had recovered, but things were still very unknown. Listen to some of the things that were going on.
22% unemployment rate. This is an extremely high unemployment rate. If you look at every single person in the United States, only 1 out of 2 people is working right now. And when you have people not working, people cannot pay for rent, people cannot even pay for groceries. And when this happens, people are not doing discretionary spending. They are not going out buying handbags. They are not.
So commerce was down in general, aside for like just the essentials. People were going to Costco, going crazy, buying toilet paper. That was a scary time when everybody was going and buying toilet paper. Now we look back and think that was kind of a crazy time. But he's being objective here. He's saying that the unemployment rate was 20%, which it was. When he sold out, it was 20%. Now the unemployment rate's like 6%. So the unemployment rate bounced back pretty quickly over the past few months. We still have scary news. The news tries to be pretty dramatic, but the unemployment rate has recovered a lot since May. So let's continue listening to this.
Vacationing, they are not going to hotels with all this lockdown. This is a serious issue. So why is the stock market so high right now? It's because of the Fed monetary policies of all the easy money going on. So the fact that it's so high right now is because of some market manipulation by the government.
This is another super popular reason of bears. Perma bears, people like Peter Schiff, that just make content that everything's negative. It's always the Fed's fault. It's always monetary policy. You should sell out of all your stocks, buy my gold. That is the main argument for most of them, is the Fed. The Fed is very, very complicated. You can study about it and read about it. They're not printing as much money as people think. It's a whole different system with banks. They are printing some money. They're likely going to have some inflation, but some inflation is actually good for the economy. And the Fed is actually wanting to cause some inflation. And so the money printing he's referring to, in most cases, it's not as big of a problem as people are making it out to be. And the thing you want to own if you have inflation are assets that can adjust pricing to hedge against the inflation. If you have your money in cash, that's the worst place to have it when the Fed's doing this type of quantitative easing and this type of monetary policy. But let's continue listening to his reasons for selling out.
The manipulation here is going to go on for some time, and we don't know how much more because they promise, oh, we're going to do unlimited amount of quantitative easing. So the bet for selling is really saying that I think the market forces is eventually going to realize, oh my gosh, things are really, really bad, and it's just going to, it might overwhelm all the easy money going on out there. The risk dramatically increases, and then people are going to sell. So this is what I'm thinking might happen. I am not completely sure. Like every single time I make these videos of these prediction videos, I am not sure. But I am sure enough that I would actually sell my own stock. Here is the way I see it. You might have 10%.
Here's when he does predictions of how much the stocks can go up based logically. Like he's kind of looked at the graph of where the stock market was before the sell-off, where it was after, and he's giving out logical reasons of why it can only go up a certain amount, and it doesn't make sense for stocks to go up above that amount, which is true. Again, his logic is pretty sound. If you actually listen to it, he's making a good case, but it just doesn't turn out well. This is the issue with trying to make predictions. Look at how clear his logic is. It's pretty solid.
Gain, right? If you have another 10% gain, we're total about down 20% from the peak right now on the S&P. So at most, right, it's reasonable that you might think that it might come up another 10%. It's completely unreasonable to think that it's going to go up to right where the peak was. In other words, go up another 20%, because that would mean that this infection is not going on at all. People are still, they went back to work and stuff. So completely unreasonable to go up 20%. So
he thinks it's completely unreasonable for the market to return back up 20%. It did that plus some. We're in the green year to date with the S&P 500 by, I haven't checked today, but it's like probably 13 or 14%. It's a lot. It's way in the green. So it didn't just go up 20%. What he said was unreasonable. It went up 30%, right? It went up a lot from when he recorded this video, when he says that he's selling out of some of his stocks. He's saying that it's completely unreasonable. Well, that scenario happened. A lot of people, they try to wrap the market into this logical framework, and it tricks people that are very intelligent because they want everything to be completely logical, but there's so many factors at play. The market did go up above what it was pre-coronavirus, and we don't know exactly why that happened other than more people are buying stocks. They want to own these different companies. I do think there's some logical reasons of why that happened because right now, there's not as many other places to invest, and the interest rates, the risk-free rate is very low. So there is some reasons of why the stock market could go up above that amount, and one of them is the stuff he's talking about with the Fed.
Let's just say it's going to go up 10 more percent, which is somewhat unreasonable already. But there's a huge case that, to me at least, because I have in my mind this amount of probability that certain things are going to happen. Let's say 50% of the time, because I'm kind of unsure, it might come up 10%. But there's also 50% of the time that I think it might go down 30%, 50%. And because the risk versus reward here is kind of uneven, unbalanced, I don't want to risk a lot of money to gain a little bit of money, because I want to risk some amount and have a high probability of success. I want to put...
He's just trying to make up his own mind about risk reward. He thinks that there's very small chance that the market could come up past 10%. So he thinks he's risking a possible 10% of gains. And the risk for that is a possible like 50% drop. When in reality, he really gave up probably 25 or 30% gains from that point, which puts him in a situation now where if he wants to jump back in the market, he's doing that at an incredibly higher price. He's in a much more difficult situation. Back in May, that was the time to be buying. That month and before, March, April, May, even June, that was when you wanted to buy. May was one of the best months to buy. If you could go back in time and buy in May, everybody would be buying everything. It'd be shooting fish in a barrel at this point. Everything was cheap at that point, but we know that now compared to today's market. So this is the issue with trying to make predictions about the future and how the overall economy and the stock market is going to react. When you're trying to make predictions about 2021, I don't think you're going to make them accurately. That's why I don't try to predict 2021, how the markets are going to react. I have some predictions. I think we're going to have a vaccine, but that doesn't say how it's going to affect the markets. Peter Lynch is someone that I reference a lot because he talks about this subject in a lot of his books. I have one of them back there that's called Beating the Street, where he talks about all of these subjects. I'll show a clip from here. But he has something that I like in him more than most big name investors. A lot of big name investors like Ray Dalio, Jeffrey Gundlach, even Howard Marks to some extent, they put a lot of kind of fear in the investor. They're always warning the investor all the time. And Peter Lynch doesn't do that. He's incredibly positive, incredibly optimistic. He's excited about companies to buy at great prices. Just go out and buy different companies that you love that are at decent valuations, and you'll do well. The companies will do well, and you'll do well. Stop worrying about this other stuff. Everybody's worrying about market crashes. They don't happen that often. And when they do, it's not a big deal. You just buy more of them. He's such an optimistic investor all the time, and he's been incredibly successful. Read about his history. Again, he's doubled the market average for like 11 or 12 years. He made Fidelity into kind of a household name. An incredible person, but he talks about this very subject of people so concerned about the future, something that's unknown, something that people focus on that they have no clue of how to handle. Here's his little spiel on this.
And then I want to conclude with there's always something to worry about. If you own stocks, there's always something to worry about. You can't get away from it. What happens in the 50s, people were worried about the only reason we got out of the Depression was World War II. We got another recession in the early 50s. They said we're going to go right back into a depression. People worried about a depression in the 50s, and they worried about nuclear war. I mean, back then...
Does that sound familiar? There's always something to worry about? Does that, sound a little bit familiar online today? Everybody's worried about everything with the stock market. Oh my gosh, what is the Fed doing? Oh my gosh, what are these different companies doing? Look at the PE ratios. Look at the interest rates right now. Look at the housing prices. Everybody's constantly worried about everything. And I think a lot of them are staying out of investing in different companies because of that. I think they're going to miss out. Let's keep listening.
And, the little warheads they had then, they couldn't blow up McLean, West Virginia, or McLean, Virginia, or Charlestown. Now, all these countries that end in STAN, there's 9 of these STAN countries that have come out of Russia. They all have enough warheads to blow the world up, and no one worries about it. When I was a kid, people were building fallout shelters, and we used to have this civil defense drill. Remember this one in high school? You'd get under your desk. I never thought even then that was a particularly good thing to do. They'd blow us, somebody put on a hat, we'd all get under our desk, But in the 50s, people wouldn't buy stocks, except for the 80s. The 50s was the best decade, this century of the stock market. And people wouldn't buy stocks in the 50s because they're worried about nuclear war and they're worried about depression. Then people, remember when oil went from 4 to 40 and it was going to go to 100 and we're going to have a depression? Remember that one? Well, about 3 years later, the same experts, now higher paid, oil's now at 10, and they said it was going to go to 4 and we're going to have a depression.
Again, people are terrible at predictions. They're terrible at it. You can't trust anybody that's making these big macroeconomic predictions. They don't know what they're talking about, and they'll say it very confidently. You listen to some people that make big macroeconomic predictions, and they will say it very confidently every time, and they have no clue. You can look at some examples. I remember when Obama became president, and the predictions were that guns would no longer exist, and gun companies would be banned, and that oil would struggle because of Obama, right? Because he was a liberal that had liberal policies, and they didn't like dirty oil companies. Oil did the best it's ever done with the biggest market cap, with the biggest gains under the Obama presidency, right? President Obama had the best oil company tenure of any president ever. And then we had President Trump, who came into office, which surely this individual is, he's very friendly to oil companies, right? Oil's done terribly. We know what's happened to Exxon and Chevron. They have done absolutely terribly. They went from the biggest companies in the world to now they're just moving further and further down the list. Nobody wants to own them. And that was the transfer from President Obama to President Trump. Nobody has a clue. And meanwhile, the gun companies that were going to disappear under President Obama had record sales. And then under Trump, a lot of them had poor sales. So people try to make these predictions. That's why I'm saying, don't just go out and buy renewable energy companies because we have a certain president. Don't sell out of your stocks because there's a lot of content being made about the upcoming market crash. None of us have a clue. Don't listen to any of it. And Peter Lynch will instruct you on that over and over again of how much we don't have a clue and just stick to buying good companies.
So there's always something to worry about. And the key organ in your body in the stock market is your stomach. It's not the brain. If you can add 8 and 8 and get reasonably close to 16, that's the only level of math you need to know. You don't know to need the area under the curve. Remember that quadratic equation and an integral calculus and the area under the curve? I mean, whoever cared what was under the damn curve? I mean, but you had to study this. You don't need this in the stock market. So all you have to know is you're going to see, it's always going to be scary. There's going to be always something to worry about. And you just have to forget all about it. Cut it all out and own good companies or own turnarounds. Study them and you'll do well. And that's all there is. And I'm ready for questions.
Okay, thank you.
That's it. Forget about it. There's always going to be concerns. Everything's always going to be scary. When you have your money invested, there's always going to be concerns. In 2021, there's going to be concerns. We certainly had a list of them in 2020. In 2022, there's going to be things to be scared about and worried about. And content creators will make content about it because people click on it and they earn money doing that. You know, there's incentive to meet demand. When people want to discuss something, there's an incentive to meet that demand. Peter Lynch is correct. The people that have sat out, that have worried about it, that have sold out of their stocks, they haven't reaped the benefit of a growing economy, growing commerce, growing innovation and technology and capitalism. Capitalism will continue to grow in this country, across the world. It's going to continue to grow. You need to stay invested. We have no clue if there's going to be a stock market crash in 2021 or in the future anytime. And the best thing we can do is buy good companies at decent values. That's the best thing. There are some companies that are overvalued right now. I think that some tech companies probably are getting pushed up to some pretty big multiples, but I don't think it's as bad as everybody's making it out to be. I remain pretty optimistic about the future. If there is another crash, if we have another 20% pull down, my portfolio will go down for a while as people sell out, and I'll look for the best deals to buy. It's not a big deal if you have a portfolio full of really good companies. So I just wanted to share my thoughts on this whole thing going on. I know you guys have probably seen a lot of those videos. And so that is my thoughts on the upcoming 2021 stock market crash and the housing market crash. I can't forget about that. Personally, I look forward to both of them. Now, moving on, I just want to give a quick update on the Joseph Carlson After Hours channel. This has been a lot of fun. I feel like less pressure to, do a specific format. I can just discuss some things on my mind. And you guys seem to really enjoy the past episode. In fact, it got 20,000 views and a lot of engagement. A lot of people watched this beginning to end. So I'm glad that some of you seem to enjoy it. I think I'll be able to come out with even better content, more interesting stuff to discuss, as well as some other random videos. Like I'm going to be doing home tours where I show you around the house, not just my office home gym. This is kind of like the man cave part of the house, but there's other rooms and stuff to show, which I think will be interesting. And I plan on doing like interviews and other fun stuff, like reaction videos and that type of thing. So I hope you enjoy the more laid back format. I think this will be pretty fun to do going forward. For the people watching that haven't subscribed yet, give it a chance. I think you'll enjoy it. If you subscribe, it's free, and I appreciate everybody that does. Now, moving on, I want to discuss a piece of news that was in one of my main episodes. So I discussed this on the main show, which all of you know, Warner Media made this big groundbreaking announcement. I think this is one of the biggest announcements of 2020. I seriously do. This is such a underrated piece of news. They announced that all their biggest movies, which this is no small production company, Warner Media is putting all their biggest movies on HBO Max as well as in theaters, which is such a customer first decision that it's crazy. I know they have business reasons why they're doing it, but it's such a decision that benefits the customer that it's not something you typically see like AT&T doing, right? When people think about big telecom companies, they think decisions to try to, take advantage of the customer. And this is the total opposite of what they're doing. Now, you've already heard somewhat of my take. Hollywood has been extremely upset, to put it mildly. They are furious about this. Hollywood at large is furious. My take is I'm not like overly concerned of Hollywood being a little bit upset about it, being a little bit disrupted. They all have money. They have very lavish lifestyles. And I'm not saying they have to be treated unfairly. I think that even if you have a lot of money, you should be treated fairly. So that's not what I'm saying. But I think a lot of the complaint is that they just simply don't like that the times are changing with their industry. And that's something that all of us have to deal with, right? It's like the journalist that said, for all the truck drivers losing their jobs, just learn to code. That's that simple, learn to code. And that became something that was so insulting to say, that people were losing their jobs just to learn to code, that like Twitter started to regulate it as kind of abuse. If you're telling people to learn to code that lost their job, that's kind of abuse. And then the journalists had a big upsetting where a lot of them were losing their jobs, and people kind of turned that back around on them. Like, you guys just learn to code now, that it's so easy to do, right? So this is a type of situation is Hollywood is in a very tough situation with their stance of being upset about this news, because they have been telling us for months. They have video montages on YouTube I could show you of them saying, stay home and stay safe, right? The coronavirus is serious. Don't go out there. Don't risk it. Have your groceries delivered. Work from home. Even if that might make you lose your job, it's worth it because lives are at stake, right? The most noble cause to save lives, unless it's to go and support our movies in the box office. That's the one risk that we as Hollywood allow you to take. We're making that one okay. If you want to go support our movies in the box office, that's fine. That's a worthy risk to take. But other than that one risk, stay home and stay safe. That's kind of the message that they're giving us. So I think they have two different things that they're having a difficult time defending here. One is that they're angry that they can't restrict consumer behavior. They can't restrict us to just one form of watching their movies, which I think is difficult in and of itself. But they're also angry that they can't restrict us into doing something that recently has been considered risky. Going out and gathering together in a theater is risky during the coronavirus. So I don't see how Hollywood has much of a defense on this. But a lot of people have pointed out that they think it's not so much a concern about that. They think that Hollywood is upset that their contracts that they made before this move is now being kind of upset. A lot of their pay is because of like box office numbers, and they're not going to get that pay. So I'll discuss that. But first of all, I want to look into the guy that made this all happen. It's this guy right here. His name's Jason Kilar. And Jason Kilar is now the doomsday. He's the villain of Hollywood. He's the one that everybody hates. He is the soulless corporate executive at Warner Media that has made such a ruthless move to go ahead and make this decision without all of Hollywood's approval first. Jason Kilar is the one that I want to talk about a minute here, because I read a profile on him, and the impression that I got was that this guy is not a soulless corporate executive. He's not trying to screw over Hollywood or do anything like that. This is somebody that he almost is kind of, he has some like naivety to him. He's just somebody that looks for fans. He looks at consumers. He wants to do what's best for the consumer. And he's a little bit naive in the way that he does that. For instance, he thought that when he made this move to put all of the movies on HBO Max, as well as in theaters, he thought Hollywood would be fine with it. He was asked beforehand and he said, I don't think it will be a problem. I think they'll be fine with it. That was obviously a little bit of a misjudgment there. But let me go and highlight a couple things about Jason Kilar. People don't really know his history. They don't know who's running Warner Media, if it is some soulless corporate executive or if it's somebody that's just trying to do good for the fans. When Jason Kilar began his tenure as chief executive of Hulu in July 2007, this is way back in 2007, is when he was the CEO of Hulu. And look at the times of what Hulu was at that point in time. Some competitors considered the streaming service so likely to fail that they nicknamed it Clown Co. They thought it was a surety. They had a surety that it was going to fail. Yet Mr. Kilar, armed with both a conviction that there was a better way to watch television and the backing of two powerful corporate parents, NBC Universal and News Corp, sequestered himself and his team into an empty Santa Monica office and got to work. He covered all the windows with newspapers, emphasizing the point that the naysayers will be ignored. That's this guy. He went into Hulu. That was a joke of a service at the time in 2007. He literally put newspapers over the windows, and he got to work. And then he says things like this, quote, "Sometimes in life, blocking out all the outside noise is a really good thing to do." That's what he said in a recent interview. Just ignoring all their complaints, and that's got to be what he's doing right now. Obviously, Hulu didn't fail. The article goes on to explain of how he turned around that service to be now one of the most popular TV services in the world, and that was in large part due to Mr. Kilar. So that's part of the reason why Warner Media was so set on getting this guy, Jason Kilar, as the CEO of their company. They saw what he did with Hulu. which he turned into a remarkably good service. A lot of people really love Hulu. Like, it is well liked. A lot of people love it. And that's mostly because of him running that company. Now, they got him in Warner Media knowing that he was going to probably do some big changes, because Warner Media and AT&T and the whole operation has a lot of work to do. HBO Max is basically failing at this point. It has not had the growth that Disney has had or Netflix has had. It's really been somewhat of a flop so far, despite them having a lot of good content. Like, HBO has a lot of good content. They just don't have something that draws it all together and sells it the same way that Disney does. So we know what happens with the story. He announces that he's going to put all the movies onto streaming in the movie theater at the same time, and Hollywood goes nuts because of this. They freak out. And it's not just Christopher Nolan. We know that Christopher Nolan was very upset by this. He said that, like, people thought they were working for Warner Media, and they woke up learning that they're working for HBO, the worst streaming service. So obviously Christopher Nolan's upset about this, but he isn't the only one that gave a strong rebuke. He just has a really notable name, so they used his a lot. There's other people, like the director of Dune, another big epic saga coming out. This is a huge movie, big epic, and he's basically saying that this decision is not only like not good for the, how dare he make this decision without telling me, but also this is economically a poor decision. So now this director that's good at making movies is a better executive, and he's better at running a corporation and making profits and determining what's economically good than Jason Kilar, the guy that turned around Hulu. That's what you're seeing, is a lot of these directors and a lot of people upset are concerned about the economics of it. For instance, one point in this, he says, streaming can produce great content, but not movies of Dune's scope and scale. That's one of the lines from a letter that the director of Dune penned himself. Warner Brothers' decision means Dune won't have a chance to perform financially in order to be a viable, and piracy will ultimately triumph. This is one of the big concerns, is that streaming will just produce reality TV shows and not really big budget, great, epic content. That is totally untrue. The economics of streaming is better than the box office. It allows for more capital, more investments. When you have more capital and more money to work with, you can pour more money into projects like Dune, big projects that will draw more attention. And as there's competition of all the streaming services like Netflix, Disney Plus, Amazon Prime, they're going to greater and greater extents with their projects and spending more and more money. When he says streaming can produce great content, but not movies of Dune's scope and scale, what does he think Dune is? Like, we have Game of Thrones. Is that not a big enough scale, a big enough project? Does he know how much money was invested in that? It's probably more than Dune between the whole saga. Look at the first series that Disney put out. The Mandalorian, I think, is a pretty well-made series. You can tell that every episode has well over $10 million invested in it, funding that project. And I suspect that there's going to be many big movies on it. I know that Amazon is going to make some huge movies. They have like the Lord of the Rings saga that they're going to be doing. So I don't think this is true at all. I think that these companies will continue to produce these big box office movies and put them on streaming just like they would in the box office. And as far as we're actually looking at the data, the box office isn't doing well right now. Tenet got like $58 million in the US box office. That is nothing compared to his previous movies. So I don't see that as a big thing from Dennis there, but you get the point. It's not just Christopher Nolan upset at Jason Kilar. It's also people like Dennis. There's a lot of people very upset about this. Mr. Kilar, 49, called the pointed criticisms painful, adding, "We clearly have more work to do as we navigate this pandemic and the future alongside them. But as he spent his career pushing against entrenched systems and was somewhat prepared for the outrage, he says, quote, there is no situation where everyone is going to stand up and applaud. He said, that's not the way innovation plays out. This is not easy, nor is it intended to be easy. When we are trying something new, you have to expect and be ready for some people to not be comfortable with it, right? For some people to not be comfortable with the change. That's okay." So he's kind of saying, yeah, they're throwing a fit, but I'm not too concerned about it. So I like seeing that response from him, saying people are going to be upset about this. Another point of criticism for Jason Kilar is that he didn't talk to all of Hollywood before making this decision. He goes on to say that how many months would it take to discuss with every talent agency, every actor, every producer about their business plans going forward? That's not really how that business works. He would have had so much blowback before doing it. At one point in this, he just says, decisions have to be made. One of the things that I'll mention about Jason Kilar that I thought was interesting with this profile on him is he has a strong commitment to making business decisions that benefit the fans above all else, that benefit the customer, the end user. And that's what everybody says that has done really well says you should focus on. For instance, Jeff Bezos has said repeatedly throughout his career since the beginning, you can go way back in interviews in like the early 2000s, and he says that Amazon focuses obsessively on the customer. We don't care about losing sales. They'll refund your purchases if you have trouble or something like that. We care about losing customers. They never want to lose a customer. They want to always have customers have good experiences using their services. And so Jeff Bezos always says to focus on the customer, don't focus on the competitors, don't focus on what's best for really anyone else except for the people you're serving, which is your customer. Jason Kilar has the same type of attitude, and it outlines some examples of how he's done this in the past. It says, Mr. Kilar says that this commitment to the customer took hold during a childhood trip to Disney World. He has kind of an obsession with Disney. As the story goes, Mr. Kilar, the fourth of 6 children, was wowed by the company's attention to detail, from the pristine landscaping to the lack of chewing gum on the sidewalk. It moved me in ways I had not been moved before, he said. From there, Mr. Kilar became an expert on all things Walt Disney. He read the biographies, scoured the libraries for more material, and finally landed an internship at the company after drawing a comic strip when his letters generated no response. So the way he got an internship at Disney was actually drawing a comic strip for them. He was most interested in Mr. Disney's entrepreneurial spirit, a quality Mr. Kilar defined as the relentless pursuit of better ways. This is something I noticed when I went to Disneyland as well. I didn't go to Disney World, but I went to Disneyland, and I did absolutely notice the quality of the park and how clean it was. That is something you do not see anywhere else. It's like the cleanest place in the world. They must have staff constantly just keeping it perfectly clean because it was pretty phenomenal. And the attention to detail is something you see with Disney. Again, it's quality. And Jason Kilar, it says that he became obsessed with that when he was a kid, especially Disney. And that's kind of grown an obsession of making things focused on the fans, attention to detail, and having quality. Mr. Kilar does admit that the company should have been more sensitive of how its announcements would be received by actors and filmmakers. So he's saying he should have been more thoughtful about the actors and filmmakers. He says, quote, a very important point to make, something I should have made a central part of our original communication is we are thoughtfully approaching the economics of the situation with a guiding principle of generosity to the consumer, to the fans. Not something I think Hollywood is particularly happy about. It says that the blind spot with dealing with creative talent may point to Mr. Kilar's emphasis on serving the audience above all else. He cares about the audience, us, more than he does about Hollywood, more than he does about his employees. He's actually fired a lot of employees since he came into Warner Media. He cares about the audience, but again, that's usually what makes businesses very successful. It gives some examples of this. He says, when making the announcement about Wonder Woman 1984, he wrote a memo that used the word fan or fans 13 times. His most recent announcement, the 17-picture deal, was titled Some Big 2021 News for Fans. So he's obsessed with fans. He's obsessed with the customer. In my opinion, that is who I want running Warner Media. And I think that so far he's doing a good job of it. If he's upsetting some people, if Hollywood's upset about some deals they got, they can renegotiate that. I think that he'll try to make amends to them. But his alliance, his direction and goal that he should go should be towards the fans. It should be towards the consumer. And I think that if he does that, it'll turn out a lot better than if he's trying to cater to executives or Hollywood or anyone else. Now let's go ahead and move on to some questions, some Discord questions. If you want to be able to ask these questions and see more in depth about the Story Fund, also some exclusive episodes, check out the Patreon. There's a link in the description. You can try it out for free. Basically, you join and you get charged at the beginning of the month. So it gives you some time to try it out and see if it's something you enjoy. So let's jump right in. David says, hi, Joe. What do you think of the recent news in relation to MasterCard announcing a new buyback scheme and dividend increase? Do you think it's a good idea, or could the cash they are sitting on be utilized better in other areas? Thanks. I think it's a good idea because clearly if they could be using this cash in way better investment opportunities or expansion, they'd be doing that. And they probably are. Some companies are profitable enough that paying out a dividend is not a sacrifice. They just have so much money, so much profits that they can reinvest in anything that they want. They can do expansion. They have all their plans. Every good area that they can invest in, they have done, and they still have stockpiles of cash. Costco, for instance, just paid a dividend of $4.5 billion. So that company had a lot of cash. It had like $12 or $13 billion sitting on the sidelines. And meanwhile, they're still expanding their stores. They're still innovating and building out their networks, but they can still afford to pay that dividend anyway. So I think that MasterCard's in a similar situation. Their payout ratio is incredibly low. They can raise the dividend just fine, and they can do buybacks as much as they want. All it's going to do is give some of the money from a profitable business back to the shareholders. Buy high, sell low says, "Hey Joseph, regarding your most recent video, are movie theaters going extinct? You expressed satisfaction with AT&T's decision to host movie releases on their streaming service for only the first month of their theatrical release. You state the reasons for supporting this decision is because it will prevent people from signing up at the end of the year and being able to watch all the movies in 1 month. I don't think that that's a valid concern. Netflix and Disney, which have both proven they know how to build successful streaming services, do not employ such rigid viewing rules. Could you elaborate further on why you support this move and how you think it compares against distribution methods of their competitors?" Sure. So there is some differences between HBO Max and Disney and Netflix. For one, Disney's kind of doing this. They're not really just releasing everything up front as soon as they get it. They're staggering their releases throughout the year. And then not only that, but a lot of the content they're releasing, like their big hit, The Mandalorian, do they release that all at once so you can watch it in one weekend and then cancel your service? Why don't they do that? That's what Netflix does, but Disney's not doing it. And their streaming service has been successful, staggering the release of The Mandalorian week by week, every Friday. People look forward to it. The reason why is because Disney knows if people could watch all The Mandalorian in one weekend, a lot of them would watch it and cancel. But now it drags it out to a few months. So I think that's clear the reason they're doing that, is it creates more buzz. It drags things out a little bit further. Netflix, of course, is the one that really does release a lot of content instantly as soon as they get it. But you got to know, Netflix right now is the library of options. It's so much content. HBO and Disney are kind of the library of quality. So they don't have as many options. They can't just put out a bunch of really high quality, super mega blockbuster movies in 1 month and then have people sign up for 1 month, pay $15 and watch like 10 movies that cost $1 billion to make. Netflix has so much content every single month that they've gotten to the point where they don't need to do that. And a lot of their content is TV series that takes months to watch. So they have stuff like The Office that they're going to be losing soon, but they've been licensing these TV series that take months to watch. So I think they're in a different situation. HBO Max has a higher quality library with less content. So it poses a greater risk for them to release all of it at once than it does for Netflix. Netflix has a lot of content, lower quality. They can release all of it at once because they have so much in the pipeline. Every single month they release more and more. Sanders says, "Do you think it's good to start early with dividend stocks on a small portfolio under 10K? Or is it maybe better to get high growth stocks and slowly switch to dividend stocks when you have more to spend?" I think that's a good question. When you're starting off with smaller amounts, I do think it's okay to take a little bit more risk. That's kind of what I did. I didn't pay as much attention to every single buy I was making when it was like a few $1,000s spread across like 50 holdings. I wasn't as concerned about it. But as the portfolio grows and I realize I'm putting a lot of capital into these different companies, I am far more concerned about the risk reward, how defensive the company is, the price point I'm buying it. When I have $20,000 in a stock, it's a lot more meaningful than when I had like $200 in one holding when I started. So I think your strategy, whatever you start with right now, is going to adjust over time. If you start with dividend stocks, you'll probably pay less attention to like the price you're buying them until later on when you have your portfolio grow to $30,000, $40,000, $50,000. So I think you just start with whatever you want. Start with growth stocks, start with dividends, have fun doing it. And I think your strategy will quickly adapt over time as your portfolio grows. John says, "After going past 500K, how are you going to protect your money in case M1 goes out since SIPC only covers $500,000? That is, that's a concern. If you have over $500,000, you lose the SIPC government insurance. And that's insurance that not only if M1 Finance went bankrupt, but like if they lost your holdings somehow. If the company goes bankrupt, that doesn't matter with my holdings, right? M1 Finance isn't holding all of my assets. That's a clearing corporation called Apex Clearing Corp. So that's a custodian that works with M1 Finance. And Apex Clearing Corp is a huge multi-billion dollar custodian that also works with Wealthfront. They work with Acorns and a bunch of other brokerages. So the actual money that you have in M1 Finance, the actual assets you have, are not actually being like held or stored by M1 Finance. They're just the broker that you interact with. They're kind of like the software layer between that. So there is better protection. The custodian, Apex Clearing Corp, also has supplemental insurance. M1 Finance, from what I've heard from the CEO of it directly, he says that they have actually purchased supplemental insurance on top of the $500,000 to where they insure each account up to millions of dollars. So I'm not too worried about it. I think the situation's incredibly unlikely, and I think that even if M1 Finance went out of business, I think it would be fairly easy to recover the money. The way that this wouldn't happen, the thing that you would have to be concerned about, is that M1 Finance is committing large-scale fraud. That's how you would really lose your money. If it was like a Bernie Madoff Ponzi scheme, and they said that they had your assets when they really didn't. They said that they had your shares, and they really did not. So in my opinion, I don't think that that's M1 Finance. They're pretty transparent. Freddie says, how is your CrowdStrike position going? Freddie, again, is the one that's a big fan of CrowdStrike, if you can't tell. He kind of pushed me into making a very small position in that in the Story Fund. I think it's up like 10% this week. So it's going good, Freddie. Thanks for asking. Subin says, have you ever suspected someone entering the Discord community with nefarious intentions? Okay. Like they enter just to shill a certain company because of how much exposure they'd get by talking up a certain company here. That's my job. I'm the one that's supposed to invest in like a small cap company, blast it out on social media about how it's going to go up 3 or 4 times. And then, I see the market cap go up on it. Of course, I have to get my position before I talk about it on social media. So that's my job. If other people are doing that, they're still in my job. In terms of people I suspect doing that on the Discord, definitely Freddie with CrowdStrike. He has a bunch of exposure to it. He loves the company. He's sharing videos on it all the time about how great of a company it is with internet security. And so I think he's shilling that company all the time. And speaking of which, he says, would you ever use margin to get into a position faster if you knew you could pay it off quickly? Technically, you're doing that frequently. Anytime you transfer money directly from your bank account to your investment account, the reason that transfer goes through in 1 day is because you're using margin, and so you don't have to wait for the 2-day ACH transfer time. I would absolutely use margin in that type of situation. If there's just a position I want to enter into really quickly, and I have I want to buy like $5,000 worth, and I have $10,000 in my bank or whatever, that's not doing anything risky. You're not really investing based off of debt. You're just timing your purchase differently. So absolutely, I would use margin to make an investment quicker into a company. If I thought that the timing was under pressure, I see no problem with doing that. Edgardo says, hey Joe, I'm on my last 2 semesters in college. Congratulations on that. You're almost done. You're close to the finish line. I wanted to ask, should I sell my stocks right now and pay some of my loans, or should I keep them and pay loans once I graduate and get a job? I get asked variations of this question just to break down the different arguments here. Should you pay off your student loans or keep investing? Should you sell stocks to pay off student loans? The argument for paying off the loans is pretty simple. Mathematically, you're paying down, you're pretty much paying for a guaranteed rate of return. If your loans are somewhere between like 4 to 7% interest rate, that would be the equivalent of buying a high yield bond with no risk, which is incredibly good. If I could buy something that paid me 5% and had no risk, I would be buying it. That'd be a really good risk return. So mathematically, paying down your student loans is probably the right decision. But at the same time, I don't like some non-mathematical aspects of this. You always seem to look for reasons. Some people look for reasons of why they can never invest. And they never get into the habit of investing frequently, all the time, and building up their assets. So I think you still need to stay somewhat invested just for the habit, just to keep things going. If you sell off your investments to pay for your student loans, next it might be a car loan, next it might be a mortgage. Next thing you know, you're like 10 years down the road and you still haven't really started investing. So I think investing is really important. Both of them are good decisions. I don't think there's any problem with selling off some of your stocks and paying down your loan. Obviously, that's a good rate of return. I probably wouldn't pay all of it off, to be quite honest. We don't know the future, like I said earlier, but we do have a president that's in talks of potentially relieving some student debt. And I've heard talk about relieving maybe $10,000 of it. So even if you pay some off, I would leave a little bit in case you have President Biden come and relieve some of your student debt. There's always an option of that happening, and you don't want to be the person that pays off your student loans right as he relieves everybody else's student loans. I know that's going to make a lot of people upset, but you might just want to wait a year and see. So something to consider. Hythor says, what motivated your higher conviction on JP Morgan now than a bit before when it was $100 a share? So why am I buying it now? Why am I buying JP Morgan now when it's more expensive than a month ago or 2 months ago? I wouldn't say that I have a tremendously higher conviction on JP Morgan. I've bought more of it, but that's kind of a result of me seeing less places now to put my money than 2 months ago. 2 months ago, I was buying the same amount of stocks. So it wasn't like I was not buying stocks. I just wasn't buying JP Morgan. And the reason why is because 2 months ago, I thought there was better risk reward. I thought there was better opportunities. I think like Disney and different companies were a better opportunity. So I put my money there. Maybe it wasn't. Maybe JP Morgan was the best opportunity, but that's the reason why I bought more of it previously than now. My conviction with JP Morgan has increased as the economy looks like it's getting better and better. We're getting better news with the vaccines and the rollout is happening. All of that makes me more have a higher conviction for JP Morgan going forward. David says, how much wood could a woodchuck if a woodchuck could chuck wood? Okay, well, on that note, I'm going to end this episode here. I appreciate all you guys. I'll talk to you next time.